Hi guys, thanks for tuning in to another episode of Nuggets News. Well, today's video is going to be an update on the entire economy and investing space. We're going to talk about stocks, bonds, gold and silver, Bitcoin, the property market, and how the world has gone absolutely crazy and assets are breaking out to record highs at a time when fundamentals would very much suggest otherwise, particularly here in the Australian economy, where we know that the coronavirus and what's happening in China is hitting our tourism, education, retail, as well as our resources, and yet stocks are breaking out to record highs. We got news today, our unemployment rate is ticking up, which is something I've been talking about. But none of this matters anymore because central banks are promising to drop interest rates and print money if anything bad ever happens. You know, look over to the US where Apple missed their guidance and their sales numbers and it has a bit of a pullback, and then the next day it's breaking out to record highs. And part of this is happening because of all the money printing that is going into the pockets of banks and investors, you know, being used for all those share buybacks. But we know that some central banks like the Swiss National Bank and the Bank of Japan are literally printing money to buy stocks. And they're some of the biggest holders in particularly these tech stocks. And that's why we've seen the NASDAQ and the tech indexes do really well. And the majority of that money is flooding into the stocks that are already the largest cap stocks. So it really is just nuts watching this all unfold. It's something that I did predict when a lot of people were talking about a stock market crash a year or two ago. And I said, this party can go on as long as central banks keep printing money. And there's been a few times in the past where we've had a bit of a tantrum and the Wall Street investors have held the Federal Reserve hostage, and as soon as they got their way, where they started cutting rates again and printing more money, you know, we're off to the races. And I think that's might be what we've got coming up in the next few days or weeks, where the Fed are now talking about reducing the repo market operation. So they're going to try and cut it back $5 billion, the amount of money that they're printing there. And I think we are going to see another tantrum, and they're going to try and hold them hostage. Markets might pull back 5 or 10%, 15%, and then again, it becomes really clear to the Fed, you've got no option. You've got to continue to print money in perpetuity. And for investors, particularly retail investors now, we always see this very late in the cycle when things are starting to go exponential. What happens? They've been taught that you just buy stocks. They only ever go up. If there's ever a dip, you know, the central banks will print money or it's going to bounce back hard and fast. And so I just think that this doesn't end well. Maybe it can go on for years and it's the biggest bubble ever, but we know that it is leading to inequality, and we'll get to that in a second as well. So a little bit more on Australia here. Some people are excited because property has had this record rebound. Again, I changed my thesis a little bit on that when the policies became more accommodative, and I said it is going to lead to inequality. Sure, you know, it's all well and good for the guy that owns 10 properties, but the people that are trying to get into the market, those that are, you know, lost their job with unemployment rate ticking higher, those that can't get the number of hours that they want, the cost of living is going up, and some people are struggling just to afford their day-to-day expenses. How are these people ever going to afford property? And we know that the talk from the central banks and policymakers was, yeah, it is expensive, it's unaffordable. And yet now we're back to around 3% from the all-time highs, and we're probably going to blow past them if they keep interest rates low, keep encouraging banks to lend, and keep printing money. And maybe they're going to ramp that up if the coronavirus really hits home. They're going to copy what other central banks have done because they think that it works and it leads to a wealth effect. But we have to keep in mind that the Aussie dollar has dropped significantly in this time. So just like gold is $2,400 an ounce in Australia, Bitcoin's $15,000 in Australia. It's because it's priced in Aussie dollars. Now, our houses have gone up, but again, remember, they are priced in Aussie dollars. The stock market's breaking out to record highs. It's priced in Aussie dollars. We need to keep that in mind. And now we've got this sort of global economy where everything's connected. That's one of the reasons why that number on paper looks really good. But in terms of value and, you know, relative to other things, we've got to be a little bit more realistic there. So one of the big drivers that I was talking about towards the end of last year and in my prediction videos that I did for Bitcoin, gold and silver, and even the halving video, I think I spoke about negative interest rate bonds being the biggest driver for the next rallies, catalysts for Bitcoin, gold and silver. So last year we got to 17 trillion of negative yielding bonds. That number dropped down to 11. I said, I think that's about the bottom. It's probably going to tick up. Well, in this month, we've jumped back up to 14. And that's where gold has had a jump in the past couple of days. I think Bitcoin's in the final sort of legs of this correction of some description before we start a new bull market. And I really do think it can be a super cycle. When you look at something like gold that has gone to these tremendous heights in just about every currency other than the US dollar, where it's even still doing pretty well there, that's a multi-trillion-dollar asset class. That market cap went from $7 to $8 to $9 trillion. Bitcoin is still just sitting there with a $200 billion market cap. So I really do think that we can get to a $100,000 Bitcoin in the next few years. And I don't want to give any forecasts further out than that. But unless anything changes, people are realizing that it's not really the price of Bitcoin that's going up. It's just the value of fiat money. Every government and central bank around the world is either printing money or governments are spending money. And we see these huge deficits now. The US are running $1 trillion a year deficit. Jerome Powell at the Fed is starting to warn about it, saying it's not sustainable. We can't have this debt keep growing way faster than the economy. The debt is so large, it's actually taking up a few percent of their GDP. Everything that happens in their economy, we've now got 3 or 4% just going towards paying the interest off on that debt. And that's with interest rates at record lows. That's why you hear people say things like interest rates are going to have to be lower for longer, because if interest rates ever go up, it's going to crush governments. It's going to crush retail households in Australia with record amounts of debt. They can't afford to pay high interest rates on all that debt. So that's why interest rates have to stay lower for longer in theory. But what governments are now talking about, and even economists were talking about modern monetary theory. Well, we just need to spend more and, fiscally get the economy going rather than relying on monetary policy. But what happens there is that you risk money actually getting into the real economy. So all this artificial money printing and QE since the financial crisis, it never really got into the real economy like I've spoken about. It just got to the banks and wealthy investors. They use it to buy back their shares, to buy more assets, and all these assets go up and it makes the top 1% wealthy. But the bottom 99% never get any of that. So what we might see if we actually get a lot of fiscal spending from the government, we actually might see inflation because they're increasing the amount of money that is in the real economy and circulating around there. So if we get inflation and that starts to get out of control like we've seen in developing nations, then you have to raise interest rates to try and stop that inflation getting out of control and spiraling into hyperinflation. So that would be the nightmare scenario. And I think that look at the politicians. They're all promising so much. They're all promising to spend more. So it's sort of a version of modern monetary theory. Increased fiscal spending has been promised in Europe. I think it's coming to a country near you where we've seen inequality, the yellow vests and all that type of thing. The government answer is not going to be to do what's right for the long term and try and get things that are sustainable or balanced. They're just going to promise everyone more and spend as much as they can. They think, hey, Donald Trump spent a lot, $1 trillion deficit, but over there, their stocks are at record highs. Everything looks like it's going pretty well. It looks like it works. And that's what's the really scary thing here. And you don't know if some of these central bankers are being genuine. In Australia, I get the impression that Philip Lowe is actually very wary of doing some of these things. But there's just not the ability to have these open, honest conversations. You get better education watching YouTube. I love the work by the guys at Real Vision. They recently did a segment about the retirement crisis. So you can watch the free videos over on their channel. They've also got a $1 trial. I think at the moment we can get all their premium content for 3 months for $1. So that's worth checking out. But in a nutshell, the retirement crisis is coming. 10,000 baby boomers a day are retiring, and they need to start spending down all the wealth they've accumulated. And just like a low cap coin for those of you in the crypto world, or a penny stock for those of you that are investors, that price that we see on a lot of assets is not really a true reflection of the real traded volume or liquidity. If everyone actually rushed to the exits on a lot of these stocks or bonds, the price is going to be a lot lower, particularly on these ETF and derivative products. So for the first time in history, we've got all these people that are basically hodlers, you can think of them as. Everyone has stocks in their retirement funds. All these funds are in the same stocks. They're all in the same ETFs. They think it's having an uncorrelated portfolio, but they all really own the same assets that are all going to turn down if we have some sort of correction. So all of a sudden, for the first time ever, we've got a lot of people that are selling those, and we've got less buyers than ever before because young people aren't really that interested in stocks. They don't have disposable income. They can't afford to keep up with the cost of living. The last thing they're doing is putting money in these stocks to buy it off the baby boomers who are outweighing them in number as well. So this is why we would think that stocks would have to have a correction with cycles and the business cycle, but at the moment central banks are just saying, no, we're going to print as much money as we need to. The Swiss National Bank, Bank of Japan, maybe the Fed next. This week we had some stories recycled about Janet Yellen coming out a year or two ago and saying that, it would be actually really good if the Fed bought some stocks in a downturn. It could, help stabilize things. So they're already floating these ideas of, hey, buying bonds isn't enough. We need to start buying corporate bonds off businesses to give them more money, even though the junk bond market's already at $1 trillion. Hey, let's buy some stocks as well. I just don't know what they're thinking. This is complete insanity. As I said, a day like today in Australia where we've got unemployment rate ticking up, bushfires, our biggest trading partners going through a pandemic, and stocks just rip out to record highs like nothing is wrong. I think it's crazy. I think it doesn't end well. I think, as I mentioned before, the negative yielding debt, where this race to go get some yield, the final 1 or 2% in the US on their bonds before they have to drop rates and go negative. That race for the bond market is going to push the amount of negative yielding debt to a new record high. That's very, very bullish for gold, silver, Bitcoin. I think they're just coming to the ends of those multi-months corrections, as I've spoken about, and gold's given us that hint of breaking out. Recently, I spoke about a trade idea where I think the GDX, the gold miners, have a lot of room to catch up there. So as you know, I have been doing a little bit of that ETF trading and investing over on eToro. You can do that for no fees. I did a tutorial on that for those of you that are interested. Otherwise, get educated. There's never been a more important time to understand what's happening. Do you know where your super is? Do you know how to protect your wealth if we get a downturn? Do you know how to get more exposure to stocks if they start printing heaps of money here in Australia? Maybe our index goes into a huge bubble. We just don't know. But having the tools to educate yourself, know what to do, understand these different markets, I just think there's never been a more important time. And tying this all together, I think the straw that breaks the camel's back is when the US dollar gets realized to not be this safe haven anymore. And people start to say, well, that 23 trillion of debt, they're going to have to print a lot of money, and that's going to really devalue the dollar. So at the moment, it's the cleanest dirty shirt in the laundry. All these other countries are printing money and they've got low rates or negative rates. The US looks relatively attractive compared to everyone else. The moment that changes, we know that China and Russia are trying to turn away from the US dollar, build their own systems. They're hoarding gold and other hard assets. So it really is that moment when the US has to join the rest of the party and people go, hold on, these currency wars are a race to the bottom, but money's not backed by anything. All these countries are printing money trying to buy stocks or buy assets off their neighbors. Then they start to go, well, we're not going to sell you our real assets, our commodities, because you're just printing money out of thin air. We want to keep those. And then it's a race to whatever is real. And we know that gold and silver are those hard assets with a long history. Bitcoin is the first digitally scarce currency in history, and unlike gold, which can have more come online when the price goes up and we start mining more, the Bitcoin halving that's coming up is making it more scarce if we get huge demand in the next market cycle. So I think everything is setting up perfectly. Technically on the charts, as I said, I think these things are coming to the end of their correction and can move higher. That can all change very quickly. So I do my daily updates for our members if you do want to join our community. But what a time to be alive. Fundamentals are out the window. Everyone's printing money. Everyone's bullish. Everyone is a buyer. The metrics we've looked at just show that everyone thinks the market is going to go up and no one thinks we're going to go down. No one's buying protection when we look at the options. What a time to be alive. If you do want more information, if you want to join that community, if you want to trade those stocks or ETFs on eToro, all that is in the description down below, guys. But please smash that like button, subscribe if you haven't already, share this video around, and I'll talk to you again soon. Cheers.